true and fair view, subjectivity and bias in financial reporting. In this lesson, we're going to explore the idea that financial statements are inherently subjective and subject to bias, regardless of what the conceptual framework may say on this matter. And we will examine the external auditor's opinion that the financial statements of a firm give a true and fair view of the state of the firm and what that actually implies. And what we're going to do is revisit asset valuation methods and examine the part that subjectivity and management self-interest bias play in financial reporting. We'll look at the gap between what many people expect from external auditors and what they can actually deliver. Finally, we'll look at the part played by auditor self-interest and actions taken by the EU to try to reduce it. So session aims. In this session, we'll learn about true and fair view, subjectivity and bias in financial reporting, earnings manipulation, and audit roles and issues, and intended learning outcomes as usual. So, director and auditor sign-off. EU and UK law requires that the directors of a company only approve accounts once they are satisfied that they give a true and fair view. It is a legal requirement in all reputable jurisdictions that the financial statements of public companies are checked by independent auditors. The independent auditor's report is intended to reassure investors and creditors that the report has been prepared according to a defined set of accepted and appropriate accounting standards and relative laws. A partner of the auditing firm has to sign off the accounts on behalf of his or her firm. And provided everything is in order, there will be a statement along the following lines. This is KPMG's for Morrison's. In our opinion, the financial statements give a true and fair view of the state of the group's and of the parent company's affairs as at the 31st of December 2018 and of the group's profits for the 52-week period then ended. True here has a very specific meaning. It implies that the financial statements are factually correct and prepared in accordance with the applicable financial standards and do not contain material errors or omissions. It does not mean that they are completely error-free. And fair here implies that they have been prepared without bias and reflect the substance of business transactions. They reflect economic reality, whatever that may be. Let's just talk about external auditor qualification. External auditors are required to report if they find anything materially inconsistent with information in the auditor group financial statements or information which is incorrect or otherwise misleading. If they do so, they report on an exception basis, and such reports are then referred to as qualified. If there are no such exceptions, then the report is termed, then the opinion is an unqualified opinion. It means that there are no qualifications made by the auditors. However, the auditor also will have a statement which will define limitations and responsibility to which they are willing to accept responsibility. So here, our audit work has been undertaken so that we might state to the company's members, as the shareholders, those matters we're required to state to them in an auditor's report and for no other purpose. It's a very narrow definition of the scope. To the fullest extent possible and permitted by law, we do not accept or assume responsibility to anyone other than the company and the company's members as a body for our audit work, for this work, or for the opinions we have formed. So other creditors, potential investors, that they're trying to avoid taking responsibility for their work to these bodies, these entities. And the extent of warranty from auditors. So they're not saying they've been through it and checked every single transaction. This is what they are giving a warranty for, that the financial statements have been prepared in accordance with the applicable accounting standards. So in the case of Morrison's, that would mean IFRS and UK standards and principles and laws, and in accordance with any legal and regulatory requirements. External auditor does not check every transaction. They take a sampling approach. They look at a sample of business transactions and look at processes rather than looking at every single transaction. And they do not accept responsibility if they fail to find something fraudulent. Two fundamental criticisms or limitations of financial reporting are that it is tainted by inherent subjectivity and preparation bias. And let's examine those, we'll start to examine those. So in terms of subjectivity, that the financial reports are giving a partial view of the firm's activities. They do not include everything that a firm is involved in. And that the values which are reporting for assets are the result of a particular set of accounting standards. The choice of accounting policies by management and the determination of accounting estimates by management. All of these are subjective in nature. And that they are inherently biased. Management are preparing a report for the owners on management's own activities. Self-interest is one of the most powerful biases that affects human behaviour. And the second criticism related to biases is that although the auditors are supposed to be independent, that the auditors are independent in name only, and that self-interest bias there taints their behaviour and their actions. Let's start off by looking at subjectivity, and we'll look at subjectivity as it relates to asset valuations. I'll start with current assets. So if we look at cash and cash equivalents, this view reflects that the values reflect management view on the risk of losses from potential bank failures. Normally, you would expect deposits with banks to be almost as good as cash, but we've seen in the case of companies holding deposits with Icelandic banks that that's not always the case. And if we look at accounts receivable, the net figure, this comes from an accounts receivable gross figure, and this is based on IFRS revenue recognition rules, which decide when a sale can be recorded. There's nothing absolute about the rules. The IFRS rules are based on when goods are delivered, rather than when orders are received. There's no intrinsic reason why they should be based on when on delivery rather than order. That is what has been agreed as a standard, but it is a human decision. And if we look at the impairment allowance, this is the allowance for bad debts. The IFRS rules on incurred losses specify conditions under which management are allowed to anticipate losses. These rules have changed over time. There's nothing absolute about these rules. And it is still a matter of management judgment that a loss event has occurred and their estimates for the level of likely losses in events. So we've got two subjective figures, the gross figure then being netted by the impairment allowance. So the accounts receivable net of the impairment allowance is inherently a subjective value. And if we look at inventory, if we've got identifiable inventory under full costing, the value will vary depending upon what method of overhead allocation has been decided on by management. Different overhead allocation will affect different products differently. And if we look at indistinguishable, the values will vary depending upon the choice of costing methods. So in the US, choice between LIFO, FIFO, and AVCO. And under IFRS, FIFO, and AVCO. So the costing method or valuation method permitted and chosen by management will affect the valuation. And we've also got this net residual value, which reflects management views on the saleability of inventory of either type. So the value for inventory is inherently subjective. And if we look at prepaid expenses is money that has been paid to a supplier for goods or services to be delivered at a future date. But that only has value if the supplier is able to deliver those goods at some stage in the future. So if the supplier goes out of business, those prepaid expenses will be worth nothing. So the value for prepaid expenses does reflect a management view that the supplier will remain in business and be able to deliver the service. If we move on to non-current assets, property, plants and equipment, so let's start off with the gross figure. If we've got the same building could be reported in the financial statements with different values depending upon how it's acquired. So if we've got a property which has been built by the firm, then it will reflect construction costs, And depending upon the choice of accounting policy, it may or may not include capitalised interest in that construction cost, or purchase cost if the property has been bought outright from a third party or from a developer. That will have a different cost than if the firm built it itself. Or an appraised value if the property was acquired as a result of an acquisition of another firm, and that will be based on a market valuation from a surveyor, and no two surveyors are likely to come up with the same value. So we can have 3, possibly 4 different values depending upon how the building has come onto the balance sheet. And then we've got depreciation. So accumulated depreciation is netted against the gross figure to give the net property, plant and equipment which appears on the balance sheet. And the value for accumulated depreciation is affected by the choice of straight line or reducing balance method for assets, and by management estimates for useful economic life, residual value, or for reducing balance depreciation rate. These estimates are judgment. They're subjective in nature. They're a matter of opinion. And we've also got a management view on whether the assets are impaired in some way, which require a further write-down. So the value for property, plant and equipment is a very subjective figure. And if you take intangible assets, the most valuable assets for many firms do not appear on the balance sheet. Only intangible assets the firm has bought or acquired through a business combination appear in the balance sheet. And in that case, the initial recognition is a purchase cost if it's bought separately, or the appraised value if it's acquired through a business combination. And accumulated amortization, the same issues for amortization those are the same issues that we talked about for depreciation applied to amortization. And finally, goodwill, which is not an asset as such, but it is reported within non-current assets. The value of goodwill is determined by the difference between how much management were willing to pay for a company bought in the past. That valuation of management of another company is a subjective valuation, and an independent estimate of appraised value of its assets at the time. And no 2 different values would come up with the same value for those assets. So the figure for goodwill is also inherently. There are frequent references in accounting standards to objective judgment, which seems to me to be an oxymoron, on the part of people preparing financial statements. The choice of accounting policies and decisions on accounting estimates and disclosures are all matters of judgment. And it's difficult not to believe that when so many management have performance-based remuneration and their jobs depend upon delivery, that the way that they report the firm's performance is not tainted by self-interest bias. That these people are not saints. And management of the company are likely to seek to show the performance and current financial position of their company to the owners of the firm in the best possible light. That seems to me to be human nature. And legitimate earnings manipulation, creative accounting, is certainly tolerated by society. It's not illegal. And in fact, you can argue that financial markets actually reward legitimate earnings manipulation, which succeeds in smoothing earnings. Let's look at the most common management reporting goals, which are higher profits and higher book value goals. And this is probably the most common and ongoing goal. And in order to achieve this, there are really 2 ways, or in combination. The first is to bring forward or accelerate revenue recognition, or to book gains from assets on asset sales. And that's on the income side. And on the expense side, to defer or push back expense recognition, and to defer writing down assets for as long as possible. Both of those will act to help increase profits and increase book value. And there are legal means to do this through operational decisions and accounting choices. So let's look at those. So let's look at some operational methods on both the income side and the expense side. So on the income side, so we're looking to accelerate revenue recognition, and we can do this by pushing in-house sales personnel. to push for more sales, and by offering incentives to customers who are thinking of ordering, to place their orders by offering them incentives, perhaps financial incentives, so that they will place their orders and take earlier delivery of goods so that we can recognise the revenue from it. And for orders that we already have, to ensure that we deliver those goods as quickly as possible, so that the sales meet the conditions of revenue recognition and we can recognise the revenue. That's on the income side. On the expense side, the typical way to reduce other operating expenses in the short term are to cut back on some of the discretionary non-operational expenditures such as training, travel, and even marketing expenditure. All of these can be cut in the short term to meet short-term profit goals. And also firms may look for one-off disposal gains to compensate for operating losses or lower than wanted profits. Clearly, this is not a source that is sustainable, but where firms do have unrealized gains, they may choose to realize those gains in a period in which their profits are weaker than they would like. And in terms of accounting choices, well, the easiest way is probably to increase estimates for useful economic life and residual value, reduce the depreciation charge by spreading the depreciation over a longer period, and by having a higher residual value. It can be some years before unrealistic estimates for useful economic life and residual value become apparent, and taking advantage of the accounting treatment of over recoveries under forecasting to increase production levels above planned levels to lower cost of sales through the reversal of over recoveries. And on the pension side, aggressive actuarial assumptions, so discount rates at the high end of the acceptable range, and optimistic estimates for bad debt recoveries, not recognizing impaired receivables, and selling financial securities that are held at historic cost for a profit while holding on to others that are showing a loss, and selective appraisal of investment properties that are being held at appraised value, the ones that have risen in value, and choosing not to reappraise any investment properties that have fallen in value. And the secondary goal is smoothing earnings growth. Two firms which spring to mind are GE and Tesco's, both of firms who had reputations for steady earnings growth over a number of years, that were subsequently found to have used creative accounting, potentially fraudulent creative accounting, to be able to report smooth earnings growth. And there is a perception that financial markets reward companies that deliver smooth earnings. But generally speaking, a secondary goal to that of higher earnings in absolute terms, but nevertheless an important goal. And so, in addition to all of these goals of accelerating revenue, we can also have a situation in which firms may wish to defer revenue recognition. So if we've got a particularly strong quarter, to actually push off recognizing revenue or asset gains, and to bring forward expense recognition, so that rather than having a bumper quarter, we just have a very good quarter, and that revenue and those asset gains can be taken in a weaker quarter in order to achieve this secondary goal of smooth earnings growth. And again, legal means there's operational methods and there are some accounting choices. So in terms of operational methods, well, it's relatively easy to cut back on sales promotion and increase prices to reduce sales. We can always cut prices in the next accounting period to take them back to the level they were before. And holding back on delivery of goods that have already been ordered. It's very easy to delay on delivery. And on the income side, firms can push for increasing expenditure on training and relaxed travel allowances. And this is an opportunity for them to take losses from non-recurring disposals to offset higher than required profits. So the goal here is basically to reduce profits in this period in order to be able to increase them in a later period. So overly conservative estimates for bad debt losses. And if a firm does this, it means that when bad debt losses do actually come in, the firm doesn't need to make allowances for those losses. And aggressive write-downs for impaired assets, which raise the possibility of write-backs at a later period when in fact the impairment turns out to be less than the firm has allowed for. And using full costing to cutting back production levels below planned level to increase cost of sales by reversal of under recoveries of manufacturing overheads. And selling financial assets that are held at a historic cost for a loss while holding on to others that are showing a gain. And this is generally the case that you do not see firms reporting small losses. Most firms manage to avoid reporting small losses. And when firms do report a loss, they tend to report a big loss. They tend to look for any other losses which may be on the horizon and take them now. Rather than report several small losses, it's better to take one large loss, recover from that and move forward. However, it is true that in the fullness of time, all money spent by a firm on current assets and wasting non-current assets will eventually find its way through the income statement as expenses and all cash received as income. Under accrual accounting, some cash flows are anticipated, while recognition of some cash flows as expenses may be spread out over many years. Accrual accounting affects the timing of the recognition of these cash flows, but it does not affect the substance of the cash flows themselves. Financial reports are all we have to base decisions on, regardless of their limitation. And then we've got fraudulent accounting. So all of those are choices which are legitimate. They are termed creative accounting, but they're not illegal. Fraudulent accounting, the most common motivation is greed, and particularly related to performance-based remuneration, stock options, bonuses, and fear, loss of job and wealth from the firm either failing or the company failing to meet its targets. And corporate culture. Sometimes we've seen fraudulent accounting which has not been driven by greed or fear, but it's simply been individuals within the company acting because everybody else is doing the same thing. So not for personal gain, helping to meet what are perceived to be corporate earnings targets. So if we look at some of the fraudulent accounting choices, probably the most common is the recognition of revenues from sales that fail to meet revenue recognition requirements. Now, some of this may be relatively minor, keeping the books open to record sales which occur in the first few days of the next quarter. But occasionally you can get egregious examples, and one which springs to mind is a Mexican home builder that over a period of 3 years booked $3.3 billion in sales of 100,000 houses that it not only had not sold, it had not actually built. And then we've got overly aggressive accounting estimates on things like depreciation, failing to recognize asset impairments when they occur, so it's overstating asset valuations and equity. And in the case of banks, this is quite a frequent evergreening, rolling over bad debts from customers to avoid having to recognize the losses from them. So continually lending more to customers in order for the customers to be able to repay loans which they've made in the past, but they're never actually going to be able to repay the loans in full. And then ways to distort the way that things are being reported. So bundling recurring expenses into reported one-off restructuring charges, and concealing losses by netting them against one-off gains. Let's move on to the audit committees. The audit committee are the guys who are supposed to be helping prevent this sort of action. So formed from the board of directors, in the UK, larger public listed companies are required to have at least 3 independent non-executive board members on the audit committee. And responsibilities of the audit committee include monitoring the integrity of financial statements and any formal announcement relating to financial performance, so the external part of reporting, and then internally reviewing controls and risk management systems, monitoring and reviewing the effectiveness of the internal audit function, so the internal audit function responsible for setting controls, and making recommendations to the board with regard to the external auditor, so the appointment, reappointment, and occasional removal of the external auditor. And this is a funny one. Reviewing the external auditor's independence and objectivity. Determining policies on taking other non-audit services from the external auditor. So this is an example where we've got a potential moral hazard. The external auditors providing consultancy work together with their audit. And if they qualify the accounts of the firm, then they also risk losing their consultancy work, which further risks deteriorating their sort of moral position. Internal audit. Internal audit is a function. It's directed by the Audit Committee and has overall responsibility for ensuring the integrity of the financial reporting system. Different definition here. The role of internal audit is to provide independent assurance that an organisation's risk management, governance and internal control processes are operating effectively. Other key responsibilities: evaluating risks, so identifying risks that the firm is exposed to and also evaluating their potential impact. And some risks firms must be willing to accept and others need to be managed actively. So part of their responsibility is determining which risks to accept and which ones to manage actively. And in addition to evaluating risk, we've also got evaluating controls, putting in controls in place, and advising management. So working with management at all levels to determine how the risks that have been identified are being managed, and if necessary, identify where action needs to be taken. Roles and responsibilities of the external auditor. So the main role is to validate firms' financial statements through the formal annual audit of the business. So more detailed principal responsibilities are providing an opinion, we've looked at that, a true and fair view on a firm's financial statements, and this is giving an assurance that they are free from material errors and prepared according to relevant accounting standards and laws. And also in terms of the firm's financial systems, reviewing a firm's financial systems, its risk management and internal controls, which means working closely with internal audit, checking that they are doing their job properly. And in order to do their job, they need to be able to obtain sufficient information to form an opinion and conduct the formal review. There is what's known as the auditor expectation gap. People expect far more from external auditors than they actually promise to deliver. External auditors are not responsible for providing absolute assurance. They examine only enough data to provide what's known as a reasonable assurance. And there's a difference between what people expect from auditors and what they actually deliver is commonly referred to as the auditor expectation gap. Issues relating to auditor, very concentrated industry structure. It is an oligopoly. Deloitte, PwC, EY, KPMG dominate the industry worldwide. Individually, they are too big to fail, and they are individually too fragile to prosecute robustly. The risk of prosecuting one of these firms robustly is that it fails as a result of the prosecution. They have been accused of having relationships with the clients which are too comfortable, too cozy. The auditor needs to be independent, and if your client is your friend, it's very difficult to maintain that independence. And there is moral hazard. The audit is a profitable business, it generates fees, and there is an element of self-interest which risks tainting the independence of external auditors. And the EU has proposed auditor rotation and also set restrictions on the amount of non-audit business billed to reduce the element of moral hazard. So very quickly, we've looked at true and fair view, subjectivity and bias in financial reporting, earnings manipulation, and the roles and issues related to audit.